The market's choppy waters have left many investors seasick. But what if I told you there is a perfect storm brewing, one that could turn your portfolio into a luxury yacht? My trusty sidekick Winston, my little adopted golden retriever with a nose for profits, has been working overtime, and let me tell you, he's picked up the scent of something big. Now, our teaching portfolio is also up 80% this year, and yes, we made money on that drop on Monday as well, because we saw not that drop coming, but the market was kind of telling us to. So if you fancy learning our secrets, then for 2 evenings next week, I'll be hosting a beginner trading challenge. No experience required, and in just 1 hour a day, I'll show you exactly how to set up trades, how to automate profit taking, and how to manage risk, and you'll be trading like a pro in just 3 hours a week. Well, I'll show you how to practice it. felixfriends.org/challenge, our first ever challenge, so come and join us. It's completely free of charge. But let's get back to those hidden gems we've discovered. We're talking about 3 stocks that are primed to explode, plus a bonus pick that will definitely surprise you. So first up, we have SoFi. Now you might be thinking, Felix, isn't that just another fintech company you keep talking about? Oh, how wrong you'd be. SoFi is sitting on a powder keg of potential, and here is why. Let's dive into SoFi's most recent performance in the second quarter. They delivered exceptional results that demonstrate their leadership as a one-stop shop for digital financial services. They hit a record adjusted net revenue of $597 million. That's a 22% increase, but it gets a little bit more interesting than that. Their rapid diversification made this record revenue possible, with just 5% growth in the original lending business, which is an intentional slowdown. So combined with their financial services and their tech platform, revenue grew 46% year over year and now makes up 45% of revenue, up from just 38% a year ago. So to put that in perspective, lending now stands at just 57% of net revenue compared to 99% when CEO Anthony Noto joined 7 years ago. But SoFi isn't just growing, they're becoming more profitable too. EBITDA profits grew 80% year over year, and they recorded their 3rd consecutive quarter of GAAP profitability, which is sort of the gold standard of measuring profitability, versus a loss the same time last year. But let's talk about their secret weapon here, their rapidly growing member base. In Q2, they added 643,000 members, and they now have 8.8 million in total, 41% increase. They've doubled their member base in just 2 years. But it's not just about member growth. SoFi members are using more and more products. They grew products in the quarter by 946,000, up 43%. Nearly 40% of all new products in Q2 were opened by existing SoFi members, showing the power of their cross-selling strategy. And here's something that should make investors sit up and take notice. Nearly 30% of new members opened a second product in the first 30 days. That's the power of SoFi's one-stop shop strategy in action. Let's dive a little bit deeper into SoFi's specific products here. Their invest offering is getting better every day. In fact, I don't know of any other self-directed product that offers alternative assets like private credit, private real estate, and private venture investing side by side with fractional shares, robo-funds, ETFs, and IPOs. And the results do the talking. SoFi saw a 58% year-over-year increase in assets under management in the invest business, driven largely by just money flowing in. Now, let's talk about SoFi Money for a moment. They've just launched the Zelle integration, one of the most requested features. But that is just the tip of the iceberg. They've created a rewards economy across all their products, including rewards for using the app and other services. And there's something exciting, SoFi Plus. their premium membership tier. It's now reached 1 million members. SoFi Plus includes their highest APY on banking balances, which is up to 4.6% today, 2 times reward points, 3.3% cashback rewards, and discounts on personal loan rates. So let's not forget about SoFi's bread and butter here, lending. Despite a challenging rate environment, SoFi's personal loan originations reached a record of 4.2 billion. Their home loan originations were the highest since beginning of 2022. And there is something that many investors are overlooking. SoFi's loan sales continue to scale at an attractive execution level. They sold 1.6 billion in total loans this quarter, 4.7 billion in the trailing 3 quarters. But the real hidden gem isn't actually the loan business, although that's going to accelerate with rates coming down. The hidden gem in SoFi's arsenal is their technology platform segment. SoFi is quietly becoming the AWS of fintech. Their Galileo platform is making good progress on the journey to become not only the AWS of fintech, but of financial services more broadly. The tech platform recorded revenue of 95 million with a contribution of 31 million in profit. And that's their 4th consecutive quarter of over a 30% margin. Given that they're kind of still scaling that, they're still building that, that's pretty impressive. Their customer wins have been more diverse, including the secure card, B2B partners. Their pipeline of interest also remains pretty robust in the US and in international fintech institutions, major consumer and commercial brands. So in short, SoFi isn't just another fintech company. It's a diversified financial services platform with a rapidly growing user base, increasing product adoption, a tech platform that could revolutionize the entire fintech industry. And as interest rates fall and people rush to refinance their loans, SoFi is perfectly positioned to capitalize. And with their tech platform segment, they're building the infrastructure that could power the future of finance. All right, let's talk about PayPal. Winston's been particularly excited about this one, and for good reasons. PayPal just released their 2nd quarter earnings, and let me tell you, it's a cracker. Their revenue hit 7.8 billion, 8% over the year increase. But their transaction margin dollars, which is essentially their profit from processing payments, grew by 8%. And that was the one thing that we all hated PayPal for, falling margins. Now, you might think, okay, 8% is good, but not earth-shattering. But to really understand this, it's the highest transaction margin dollar rate, growth rate since 2021. So they're not just growing, they're actually accelerating their growth beyond anything we've seen since COVID. But let's dig a little bit deeper. Total payment volume, which is the total value of payments processed on the platform, grew to 416 billion with a B, 11% up over the year. To put that in perspective, well, that's more than the GDP of most countries. But it's not just PayPal's core business that's thriving. Venmo, their peer-to-peer payment app, is also showing strong growth. Number of monthly active accounts grew 5%. Total payment volume also increased 8% over there. PayPal's non-GAAP earnings per share grew 36%. That's a massive increase and completely caught Wall Street off guard here. But it's not just about these numbers, okay? Numbers sometimes get a little tedious. PayPal is innovating and expanding. They're rolling some of the best payment option out there called Fastlane, which is set to revolutionize online checkout. And early results show it's achieving about 80% conversion for returning users compared to the industry standard of 50% for guest checkouts. And if you're worried about PayPal's financial health, just don't be. Free cash flow for the quarter was 1.3 billion. That's a lot of cash to reinvest in the business or to return to shareholders. And speaking of returning value to shareholders, PayPal repurchased $1.5 billion worth of shares in the quarter. That's more than cash flow. And over the last 12 months, they've reduced the share count by 6%, which creates tremendous value for us shareholders. But it gets better. PayPal is so confident in their future that they've raised their guidance for the full year. They're now expecting low to mid-teens growth in earnings per share, up from their previous guidance. And if you combine all of this with the fact that PayPal is a huge beneficiary of falling interest rates, you got a recipe for potentially explosive growth. As rates fall, consumer spending typically increases. More transactions mean more revenue for PayPal. But there's something many investors are overlooking: PayPal's potential in the business-to-business space. With the acquisition of Braintree and the development of PayPal Complete Payments, they're positioning themselves to be the major player in the massive B2B payments market. The global B2B payments market is expected to reach 200 trillion with a T, not with a Biden B, by 2028. I know it's an old joke, but you know. And PayPal is basically perfectly positioned to capture a big slice of that delicious pie. But don't forget about partnerships. They've expanded some of their partnerships with companies like DoorDash and Meta, which could open up entirely new, bigger revenue streams. And they're no longer doing that at super low margins. They now are focusing on high margins and a little bit less growth. So those deals should be pretty sweet. In short, PayPal isn't just a good investment. In my humble opinion, I think it's a great investment. Strong financials, innovative products, massive growth potential. It's no wonder Winston likes the new CEO. And that's, of course, the real story here is the new CEO is going to need a few more quarters to show what he's really made of. But this last quarter was pretty impressive. If he continues to deliver on that front, I'll be very, very happy. Now, of course, none of these are financial advice. Go away and do your own research. But shall we get on to stock number 3? Well, let's. And then 4 will be a real surprise for you. Our third pick is Microsoft. Yes, Microsoft, the tech giant that's been the staple of portfolios for decades. It's also the biggest position I have. And you know what? It's down 15% in the last month as I'm recording this. Now, some might see that as a red flag, but let me tell you why I believe it's actually a golden opportunity. Microsoft just released their fourth quarter earnings. And, well, annual revenue exceeded 245 billion. Up 15%. That's just the tip of the iceberg, though. The real star of the show for Microsoft, it's cloud. Revenues are up 23% over the year to 135 billion. They're not just growing, they're accelerating their growth. And let's dive a little bit deeper into Azure, Microsoft's cloud computing platform here. Azure's market share gains accelerated this year, driven by AI. And they expanded their data center footprint, announced investments that are across all continents. Well, maybe not the ones with the penguins. And these are long-term assets that will drive growth for the next decade and beyond, in my humble opinion. Microsoft now has over 60,000 Azure AI customers, up nearly 60% year over year. And the average spend per customer continues to grow. So we're not just talking about tech companies here. Azure OpenAI service is being used by leading companies in every industry, from H&R Block to Suzuki to Swiss Re and Telstra, as well as Freshworks, Zomato, loads of tech companies, and all sorts of companies, spots. Okay, there's another bit that people often don't realize Microsoft actually owns. It's GitHub. And they introduced GitHub Copilot. And it's by far the most widely adopted AI-powered developer tool. Just over 2 years since it became available, more than 77,000 organizations have adopted Copilot, up 180% year over year. And we're talking about big companies like BBVA, FedEx, H&M, Infosys, and so on. But Copilot is driving GitHub's growth. GitHub's annual revenue run rate is now 2 billion. Copilot accounted for 40% of GitHub's revenue growth this year, and it's already a larger business than all of GitHub was when Microsoft acquired it. Talk about AI being a real thing. But Microsoft isn't just stopping at developer tools. Copilot for Microsoft 365 is becoming a daily habit for lots of people. The number of people who use Copilot daily at work nearly doubled quarter over quarter. Copilot customers increased more than 60% quarter over quarter as well. So we're not just talking about small businesses here. The number of customers with more than 10,000 seats more than doubled quarter over quarter. including companies like Capital Group, Disney, Dow, Novartis. Ernst & Young, EY alone, will deploy Copilot to 150,000 of its employees. And let's not forget about Microsoft Teams. This company is so diversified, we could talk about it all day long. Teams is now essential to how hundreds of millions of people meet, call, chat, and so on. They once again saw year-over-year usage growth. Teams Premium now has 3 million seats, 400% up year-over-year. And I didn't get it. I thought that just looks like Zoom, looks a bit like Skype. Why would anybody subscribe to it? But it's the power of Microsoft's network and sales efforts. People who run their business on Microsoft will buy pretty much anything that Microsoft puts out, as long as it's half decent. But there is something that's flying under the radar of most investors. Microsoft just introduced a new category of Copilots Plus PCs. These are the fastest, most intelligent Windows PCs ever, with a new system architecture designed to deliver the best breakthrough AI experiences. And speaking of Windows 11, active devices increased 50% year over year. They're seeing accelerated adoption of Windows 11 by companies, big companies, Carlsberg, E.ON, National Australia Bank, and so on. But perhaps the most important aspect of Microsoft Business is actually security. They now have over 1.2 million security companies, over 800,000, including Dell, Deutsche Telekom, TomTom, use 4 or more workloads, again up 25% year over year. And you might want to pay attention to the following bit here. Defender for Cloud, their cloud security solutions, surpassed $1 billion revenue over the past 12 months. In short, Microsoft isn't just a tech company, it's a diversified tech powerhouse that's leading the AI revolution, from cloud computing, developer tools, to productivity software, security. Microsoft is at the forefront of kind of all of it. And with its stock down 15% in the past month as I'm recording it, it presents a pretty sweet buying opportunity for long-term investors. Not financial advice, obviously do your own research, but you know what I'm going to be doing. Now, I know what you're thinking, Felix, okay, these are all tech companies. We know them. This is not that new, but what about something different? Well, that's where our bonus pick comes in. Atlas Copco. Now, I know what you're thinking. Atlas who? These guys are Swedish. They're an industrial giant, a hidden powerhouse. And how did I find them? One of my favorite investing fund managers, Terry Smith, just started nibbling at them, and I thought, let's dig a little bit deeper into this. So first off, these guys have maintained dividend payments for 45 consecutive quarters. Oh no, years, not quarters, years. That's longer than I've been alive for. Maybe some of you've been alive for, but it gets better. The return on invested capital is a staggering 23%. And for me, that's always a really good metric of like, what's the stock price going to do? So that's the kind of efficiency that honestly would make pretty much any investment banker or investor or fund manager weak at the knees. But let's dive into their recent performance a bit more. Atlas Copco just released their Q2 earnings results, and they're pretty impressive. Orders received were 43,000 million kroner. That's billion, isn't it? Which is about $4 billion US. Let's try to stick to US numbers here. That's essentially flat year over year. And you're kind of thinking, why are you telling me to buy a stock that isn't growing? But look, in the economic environment, especially in Europe, especially in industrials, that's quite an achievement. Their revenue hit, as I say, that those 4 billion, it's about 3% up from last year, actually. So, but it gets a bit more interesting. Their operating profit was pretty significant, with a margin of 21%. That's a profitability margin that many industrial companies can only dream of. Now, you might be wondering, okay, but what do they actually do? Get to the point. Well, they're a global leader in compressed air and gas systems, vacuum solutions, industrial power tools, and assembly systems. Clear, right? Now you know. But what really sets them apart is their focus on innovation. In the compressor technique segment, they introduced a new energy-efficient air-cooled desiccant dryer. In vacuum technique, they launched a new integrated vacuum and abatement system that helps customers lower energy consumption and reduce their carbon footprint. That's a big thing around nowadays. And in the industrial sector, they introduced a new cordless range of nut runners, supporting the air-to-electric transformation in general industry. And I don't really fully understand what that means, but apparently it's exciting. And then in the power technique segment, they launched a new medium-sized energy storage system that enables the creation of microgrids at infrastructure construction sites. Sounds like a good idea. And they operate in 180 countries. Gives them incredible geographic diversification. They saw growth in all regions except for Asia in the last quarter, which is probably the China slowdown, showing their ability to navigate different market conditions. So in short, Atlas Copco isn't just a dividend aristocrat. It's a global industry leader with a focus on innovation, strong profitability, and a commitment to, well, having a diverse portfolio, global presence, being well positioned to weather whatever the heck happens out there and benefit from long-term industrial trends. So let's recap here. We've got SoFi, the future of AWS or fintech, poised to skyrocket as rates fall. We've got PayPal, a payment giant with massive growth potential in B2B and a CEO who's really like uprooting everything over there in a good way. Microsoft, a tech giant leading the AI revolution, and Atlas Copco, the industrial powerhouse you've probably never heard of. These four companies represent diverse opportunities, from fintech to payments to cloud computing to industrial equipment. And remember, our teaching portfolio is up 80% this year. That's from trading. So we made a $24,000 gain on a $30,000 portfolio so far this year. If you want to learn how we do it, join our beginner trading challenge this next week. For 1 hour on 2 evenings at 8 p.m. New York time, I'll teach you everything you need to know to start trading like a pro in just a couple of hours a week. Visit felixfriends.org/challenge to secure your free spot. Link is down below. And until next time, this is Felix and Winston signing off. Happy investing. Felix here. If you're worried about how far this market's going to crash and what's going to happen to your favorite tech stocks next week, then this is the video for you. We're going to run through Nvidia, the S&P, the Nasdaq, Palantir, Apple, Tesla, Microsoft, Neo, Alphabet, Amazon, Meta, PayPal, SoFi, maybe one or two other names we can think of along the way.